Let's dive right into this, shall we? Welcome to today's Explainer, where we're unpacking JetBlue's incredibly dynamic financial turnaround story. If you follow the airline industry at all, you already know it's a sector flying through some pretty serious turbulence right now. So today, we are going to break down exactly what JetBlue's latest Q1 2026 filings and earnings releases reveal about their strategy to navigate these very choppy skies. Right off the bat, we've got a massive number to talk about, $2.2 billion. That is JetBlue's Q1 2026 operating revenue, which marks a really impressive 4.7% increase year over year. But you know what makes this so fascinating? They actually achieved this top-line growth despite decreasing their overall system capacity by 1.7%. They are literally flying slightly less, but somehow earning more. Let's find out how they're pulling that off. Here's our flight plan for the Explainer today. 1. The Q1 financial reality check. 2. The rising cost headwinds. 3. The Fort Lauderdale pivot. 4. Debt and liquidity. 5. The updated Q2 outlook. And finally, number 6, the final boarding call. All right, part 1. Q1 financial reality check, where strong demand meets a margin squeeze. Looking at where that $2.2 billion actually comes from, core passenger ticket sales are still the absolute heavyweight here, bringing in over $2 billion. That's a solid 4% bump from last year. But you definitely want to pay attention to that other revenue category. This includes stuff like baggage fees and loyalty programs. It's sitting at $192 million, sure, but it is growing at a much faster clip of 12.5%. Now here's where things get a little tricky. This is the crux of the margin squeeze. Their revenue per available seat mile, or RASM, grew a very healthy 6.5%. Basically, they're effectively squeezing more dollars out of every single seat. But their operating costs, the CASM, actually outpaced it, rising 8.3%. And the key takeaway here is simple economics. When your costs are growing faster than your unit revenue, your profit margins are absolutely going to feel the pressure. Moving right along to part 2, the rising cost headwinds. Let's talk operational disruptions and fuel prices. I actually really like this quote from CEO Joanna Garagati because it completely sets the tone for their current strategy. Management is clearly acknowledging this volatile macro environment. I mean, they know they can't control global oil markets, right? So they're pivoting their focus strictly to controllable operational efficiencies, things like capacity adjustments and cost containment under their JetForward initiative. And yeah, ouch. This right here is exactly why they have to be so incredibly disciplined. Back in Q1 of 2025, they were paying $2.57 a gallon. By Q1 of 2026, that had jumped to $2.96. But the real shocker is their forecast for the upcoming second quarter. They are bracing for a massive spike, hitting a maximum of $4.36 per gallon. That is just a brutal headwind for literally any airline to face. Okay, part 3, the Fort Lauderdale pivot. Let's see how they're capitalizing on new routes. Honestly, JetBlue has been super opportunistic here. By capitalizing on Spirit Airlines' shutdown, they heavily expanded their footprint down in Florida. We're talking a massive 23% capacity growth in their Fort Lauderdale hub alone. And here's the crazy part. Despite flooding that market with extra seats, their unit revenue still went up by 5%. It is a brilliant tactical move to capture abandoned market share, and it pairs nicely with a 19% growth in cash from their TrueBlue loyalty program. Now, across their entire network over the 12-month period ending in early 2026, they transported 39.4 million passengers. While that total volume did dip slightly by about 3% compared to the prior year, this highly targeted hub strategy in places like Fort Lauderdale ensures they are flying much more profitable routes. It's a fantastic reminder that in business, the quality of your revenue often trumps sheer volume. Which brings us to part 4, debt and liquidity overview. Grounding the billions. If you're an investor, these numbers should give you a bit of breathing room. JetBlue ended the first quarter with $2.4 billion in liquidity. That means they're holding 26% of their trailing 12-month revenue in reserve. Since their internal safety target usually hovers between 17 to 20%, they are sitting very comfortably above their own threshold, proactively making sure they have real financial flexibility. And here is another really positive signal straight from their filings. Their weighted average shares outstanding remain incredibly stable at 370.8 million for both basic and diluted shares. So why does this matter to you? Well, it means they aren't out there actively diluting their shareholder base just to raise capital. They are protecting the value of existing shares even while they navigate a period of unprofitability. But let's be real, we can't ignore the elephant in the room. That debt load is heavy, sitting at $8.4 billion. To handle it, they are playing serious financial defense. They just executed a new $500 million aircraft-backed financing deal, and they used cash to repay $325 million in convertible notes. Plus, they've got this massive safety parachute, over $6 billion in unencumbered assets. That means they have planes and equipment they own outright, which they could borrow against if things get really tight. Part 5, the updated Q2 2026 outlook. Let's look at how they're upgrading the flight plan. This right here builds a really strong case for optimism. They have bumped up their revenue expectations, moving the target from a max of 11% up to a massive 12% year-over-year growth. And at the exact same time, they are keeping their non-fuel cost growth strictly contained at 3 to 5%. Generating better revenue on the exact same cost expectations, that is a massive win for the airline. Simultaneously, they're tightening the belt on their cash output. They've trimmed their capital expenditure estimates by $50 million for the quarter, dropping it down to $225 million. This kind of immediate cash preservation is designed directly to help offset that brutal fuel price surge we looked at just a minute ago. In fact, JetBlue believes they can recapture about 40% of those rising fuel costs through better revenue and these strategic cuts. And you know what? This sunny, upgraded outlook is actually backed up by the reality on the tarmac. Quarter to date, they are boasting an incredibly strong 99.8% flight completion factor. That literally means almost every single scheduled flight is taking off and landing exactly as planned. When your operation runs this smoothly, it completely eliminates the massive hidden costs of rebooking angry passengers, handing out hotel vouchers, and paying crew overtime. And finally, Part 6, the final boarding call. Will the turnaround take flight? Ultimately, the big question for anyone following this company is this. Will these really precise operational pivots, like absorbing Spirit's old routes and slashing capital expenditures, truly outclimb the macro headwinds over the horizon? With fuel prices threatening to touch $4.36 a gallon, the margin for error here is razor thin. JetBlue is executing a fascinating high-wire act in the aviation space right now. The only question left is, will they stick the landing?